All right, should be up now, but the meeting's going to start in 2 minutes. If someone has a link to the YouTube, if they want to post it, I think the video quality is a little bit better in the YouTube than it is through the VTF when I'm streaming through both at the same time. What is the feedback that I hear? Yes, we're starting in about 1 minute. Again, if anyone has the link to the YouTube, if they want to post in the VTF, I think the video quality sometimes is a little bit better into the YouTube than it is through the VTF. Thanks, KP. We can assess it in a minute. We'll see. It's very difficult. All right, it's 10 after, so let's get started. Because I am live streaming this on YouTube, I have to do this disclosure. I am an associated member of T3 Trading Group, which is an SEC registered broker, dealer, and member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure here, only thing that's new since the last afternoon meeting that I broadcast was VXX. All right. We got a lot of things to talk about here. So, again, first of all, if you're here as a guest, welcome. heck of a first day for you guys, which is great. Today was not an easy trading session by any means, which we will discuss. But sorry, I thought someone was knocking on the door. Today was not an easy meeting yeah, for real. Today was not an easy day by any means, but it's a good thing because there's actually a lot to learn from today. So there's a lot of like little mini lessons that we can draw from today's price action so that we can all learn and hopefully be better traders going forward. First, real quick, just want to say this again. The ProDesk VTF here somewhat recently started a Twitter. So if you guys want to follow at ProDesk VTF, we get a lot of little lessons and stuff posted in here. That's at ProDesk VTF. We recently started a YouTube for me here at the company. It is the Derrick the Trader YouTube. 172 subscribers. We just started it like last week. I want to see this number higher tomorrow. There's like way more people in the VTF today than there are subscribers. So if you can give me a subscribe on the YouTube, I would really appreciate it. And just real quick on business before we jump into things. Robert, please. I'm not bringing that one up. Real quick on business. We got a really great team here in the ProDesk virtual trading floor. If you're interested in becoming a subscriber on it, you want to reach out to info@t3live.com. If you're interested in being a professional trader with T3 Trading Group, you want to reach out to info@t3trading.com. Okay, with that said, let's get into the meat of our meeting. There's a lot to talk about. SPYs closed down 1.85%. There's blood in the streets. Qs 2.3%. IWM 2.6%. That's after the rip-roaring rally that we saw here in the last half hour, though I see that the SPYs in the market's already trading down 75 cents or so from where we closed, 60 cents from where we closed. Makes sense. Just a ton of volatility today. Okay. There's a lot of lessons from today's price action, and I want to try to be able to get through all of them so that you guys can all learn. So we'll just kind of go through them one at a time. I tried to write down like a little note for me on each one so that I don't miss it. First thing I want to talk about is opening gaps in the market. When you have a big gap down like you had today, how do you deal with it? What are you supposed to do? Because I really tried to outline a game plan for us in the morning meeting, and that game plan actually worked out pretty much perfectly. So my approach to markets is big picture down to small picture. I think even if you are a day trader, the big picture is so important to day trading. Your entire probability of success hinges upon what the market does, and recognizing the intraday movements in the market all stems from big picture positioning and big picture flow. So what we need to assess on a really large gap down, I forget what the percentage was, but this is the biggest gap we've seen in a while. And there's all these different types of names when it comes to gaps, right? Common gaps, area gaps, breakaway gaps, continuation gaps. And I have a whole class in my training program that discusses those. But the root of it, when you're trying to assess a gap, is the following question is what you're asking yourself. What does this gap do to the participants who are already in the marketplace? The participants who are already in the marketplace, are they viewing this gap as an opportunity to buy? Are they viewing this gap as an opportunity to sell? Is this gap making people who are already in the market trapped in one direction or another, who are then going to be forced to do certain things? That's what we're trying to assess in today's big gap up. Today's big gap down. So I'm trying to balance this morning an understanding of basically the following two situations. One is we know that there's a lot of cash on the sidelines that's been waiting for a dip. Is this gap down, is this dip big enough to bring new buyers into the market to come in and take advantage and buy the dip, versus panic sellers who are already in the market, right? Because where we opened in the SPYs today, what's our opening price? 434.88. The opening price of 434.88, this opening price puts every single person who has bought the SPY over the course of 2 months, all of September, all of August, and the second half of July. If you purchased a SPY at any point over the course of the last 2 months, you woke up today and your position is out of the money. What do people do when they're out of the money? Well, it depends on a number of things. But if they manage risk, a lot of times what they might do is sell. If they see they're losing money, a lot of times what they might do is panic and hit that sell button and get out of the position. So, and on certain occasions, if the market goes down enough, then you might even encounter margin calls and kind of things of that nature. So what we're really trying to assess this morning into the degree of the gap down is this a large enough dip to bring in the dip buyers? And do we have panic sellers? And if we have both, what's going to be the ratio of the two that's going to create the opening price action? That's what we're really trying to figure out. The other thing that you need to balance is this really important trading concept. It's really important for my own trading, which is extension. Okay? The way that I measure extension in the marketplace is where the market is trading versus the space between the 8 and 21 EMA. This could be any time frame chart. This could be a 5-minute chart, a 15-minute chart, hourly chart, daily chart. Where is the market trading versus the space between the 8 and 21 EMA? The space between the 8 and 21 EMA, the 8 EMA here is my blue line, the red EMA, the red line here is my 21 EMA. The space between the 8 and 21 EMA is what I consider to be technical equilibrium for any stock or market that I'm looking at based on that time frame. So if I have a market like right now that's trading at 433.60 and the 8 EMA is at 443.44, so 433.60 versus 443.50, we are extended in the SPYs by $10. I actually prefer to look at that as a percentage versus just a dollar amount, but whatever. That's the degree of extension that we're experiencing today. We are, as of right now, with where the SPYs are right now, and by the way, we're $5 off the low of the day. But with where we are right now, we're extended to the downside based on the daily chart by $10. And at one point today, it was $5 lower. So it means we were extended by $15. Now, the thing about extension that you have to realize is that a market that is extended can always become even more extended. This is especially true on the downside of the market because fear is a stronger emotion than greed. So markets that are going down tend to go down much faster than they go up, which also means that you tend to be able to see greater downside market extension than upside. And again, this is just, we're talking in general terms here, general rules. So to go back to coming up with this morning's big picture game plan, the big first thing that I want to see here this morning is how does the market on a small time frame handle the gap down, recognizing the supply and demand dynamic that we discussed of panic sellers balancing dip buyers, right? And on the opening price action, the small time frame, I want to pay attention to that extension. So let's go to a 5-minute chart. 5-minute chart, basically picking up where we left off. So when the market opens, the ADMA on the 5-minute is like 440 and change, and the opening price action, we're at like 435. We're extended by like $5-6 here at the open on the SPYs on the small time frame. That's a lot, but the market's going to rapidly catch up to it, right? As you can see here, because the gap down was so big, the slope here, the SPYs, was heavily to the downside. It rapidly catches up. So what I want to see here, the first thing I'm looking for on a day like today is what I call the opening low. And I want to be long versus that opening low. What I don't want to be doing is I don't want to be hitting the short button the second the market opens. And you might be thinking, oh my God, the panic sellers, I want to take advantage of them. And sometimes that's true. Sometimes even when you gap down really big, you actually still can take advantage of panic selling that's coming in. But that panic selling, when it happens, and we didn't get it this morning, when it happens, it's relatively short-lived. It tends to last 10-15 minutes. Sometimes on really bad days, panic selling can last as much as 30 minutes. But usually it's 10 to 15 minutes of panic selling. So again, question is, are the dip buyers going to come in right away? Is there going to be panic selling right away? And I don't exactly know the answer to that, but I do know that we're going to get an opening low that I want to be long versus. That opening low can happen in the first 5 minutes like it did today if dip buyers come in right away, or that opening low can happen after like 15 minutes or so if we see initial panic selling, which makes our market that's already extended to the downside even more extended to the downside. And then the smart buyers kind of come in, or the panic selling abates, and you can kind of then see the market start ticking higher. So that's the first thing I'm looking for. I'm looking for opening longs versus the opening low, whether that's an immediate low or a panic selling low, depends on the day. Today it was basically an immediate low. And then what I'm looking for is price or time correction on the small time frame, which basically means, is the market going to trade up to the ADMA, or is the ADMA going to trade down to it, or a combination of both? That's the initial thing that I'm looking for. And we had some decent opening drive long trades right in the first 5 minutes of the day where we got that strong rally. Now from there, when you get that opening rally, exactly what I'm describing, whenever you get that bounce off the opening low, the opening low is key for the rest of the day. Because if selling is coming in post 10 a.m. That's not panic selling anymore. That's real selling. That's institutional selling. And it's one thing to come in and take advantage of panic retail selling that's coming in the beginning of the day because the market is gapping down. It's something entirely different to think that you can come in and you can buy when the market is working with institutional selling. You don't want to do that. So that opening low, in this case is the first 5 minutes of the day, the dip buyers tried to come in right away. We didn't really see any panic selling. That opening low becomes key, because if the opening low breaks post 10 a.m., that's a signal that there's real institutional selling. And if there's real institutional selling, most likely that selling is going to last for probably the majority of the day, if not the entirety of the day. And that's exactly what happened. So again, going back to our opening big picture game plan for today, what we said was we want to go long versus that opening low. If the opening low breaks and it's confirmed by multiple indices, confirmed by the VIX, get out of the way. So if you took decent opening trades, and there was a few, like Apple's initial bounce here was fast and furious, but it was there. The SPYs themselves, the Qs themselves, SoFi was one that I was looking at here off the open. That gave a great initial bounce. Similar but different was this Sumo, because Sumo actually sold off into support, but $17 was the daily support, where that was where I was coming in and looking at Sumo long. Like, these were some of the callouts I had, and I know you guys here in the VTF had other callouts and other names that you guys were looking at in addition to that. And we caught that opening bounce. And if you're honestly, this opening bounce is not great, because we couldn't even bounce to the 8 a.m. and the 5 minute. There's multiple signs here today that the market was extremely weak. One of them was the lack of bounce. If you guys remember in the morning meeting today, I said probably the most bearish thing that we could see is if the market just goes sideways off the open. And we didn't purely go sideways. We got this 15-minute bounce here in the beginning of the day, so we did see a little bit of price correction, but it was at least as much time correction. It was at least as much the market going sideways as the market was catching the bid. Why am I saying to you guys in the morning meeting that one of the most bearish things that we could see on this gap down this morning would be sideways price action? Because again, sideways price action that's not panic selling. That's dip buyers trying to come in and failing, and real sellers being there, institutional sellers coming in and basically creating a bear flag, right? If you just went sideways, and again, we didn't go perfectly sideways, we had a little bit of a dip, but if you just go sideways here, that's one of the most bearish things you could see, because we're entirely digesting through time as opposed to price. The gap down, the ADMA is catching up. It's going to add weight to it. And it basically becomes a bear flag, with the flag pole being the gap itself, and the price action on the open going sideways being the flag. So this morning we had a bounce, but it was kind of a shallow bounce. I still think it was enough where if you had good execution in the first 5 minutes of the day, it bounced enough that you should have been able to at least cover your risk on your trades, so that when you're getting stopped out on those longs when new lows come in, that you're not getting hurt on that, you're not losing money. And if you executed really well, or you had the right stocks, you actually could have been making money off that opening bounce. But once that opening low broke, and it was confirmed by the VIX making new highs, and it was confirmed across multiple indices, the Qs made new lows, the IWM made new lows a little bit later. The IWM actually had a better price correction here than the other indices did. But once you had that confirmation across the board, by 10:30 for sure, if not even a little bit earlier than that, I knew I needed to go more hands off. It's like, all right, took the opening long trades. We're not getting higher lows here. We're breaking opening lows. Again, that is the signal to me of real institutional selling. That institutional selling could last potentially for the entirety of the day. I just need to get out of the way. And if anything, although I didn't take this trade, your short signal. So for people who wanted to short today, and I'm not necessarily saying that shorting today was a great idea, because we were just so extended on the big time frames, but we know that down markets can easily become more extended. Your real short signal was this bear flag that developed into 11 a.m. This is a bear flag. It's basically exactly what I was just describing on a 5-minute on if we went sideways, but it's over the course of a 15. Like, we tried to have a little bit of a rally here in the first 15 minutes of the day. We tried to price correct. We came down back down to lows. We went sideways. This is a 15-minute bear flag with the gap itself acting as the flag pole, and it is very typical that that flags are going to give continuation when the 8 EMA on its appropriate time frame catches up to the base. So in any flag pattern, you have support and resistance, right? So the resistance for the bear flag on the 15-minute was about 435. The support was about 434, maybe a little bit below it, 433.75. So you had a bear flag range here of like $1.25. Once this ADMA actually catches up, and it took a while for the ADMA to catch up because the gap was so big, and it coincides. I actually love this. I love when my flag patterns end with an inside bar because you can execute off the inside bar. So the ADMA catches up right as you have this inside 15. The inside 15 breaks down as the ADMA catches up. We are no longer extended to the downside on the 15-minute chart of the SPYs. It was a time correction, not a price correction. Bam, we broke down. We led to all the rest of this downside price action for the rest of the day. And that was basically it. I think those are your opportunities today. And then in this midday price action, I still think you don't want to do much. 11 to 2. I guess the 15-minute breakdown was more like 11 to 11:30. But once that breakdown occurred, and again, I'm not even a huge advocate of taking that as a short. I'll tell you who I like this as a short trade for. I like this as a short trade more for the people who have longs on, like long portfolios, multiple, like I do, because you're hedging yourself out here more than I like it as a pure trade, though it really could have been both. Once this broke down, though, then you just kind of need to be out of the way. You kind of needed to be out of the way for a lot of this midday price action. The sell-off was occurring, and that was basically it. That's kind of your big opportunity, and that's how the market worked. And then the next thing I need to talk about is this rip-roaring rally into the close, and I also need to talk about MOC. So those are the next two kind of mini lessons from today, based on some of the guys' questions that were going on in the VTF. Okay. So now we know we have institutional selling, right? We're just grinding down. VXX is grinding up. Market is extended on the big picture, but it's becoming even more extended. We definitely know that can happen. A couple of things. So I was talking about one phenomenon that's a market phenomenon we see. We actually usually see this more to the upside than the downside, but it occurred today as well. A lot of the times on these major intraday trend days, usually it's on the upside. So you're trending higher, that grindy trend all day that's kind of riding the ADMA up all day, where it's a really strong day. A lot of times you see a rollover in the last 15 to 30 minutes or so. And basically what's happening there is the intraday trend following traders and trend following algorithms are just saying, okay, I caught this great uptrend all day, let me sell to book my profit. Selling starts to bring the market down. The market coming down, so markets work in feedback cycles, right? The market coming down breaks the last pivot low. That sets off more sell stops. Breaking the last pivot low leads to more selling that leads to the next break of the next pivot, or the next break of the pivot low on a little bit of a larger time frame that leads to even more selling. And then what ends up happening is you had this nice grindy uptrend all day that's followed by a little rollover sell-off into the close. Today we basically saw the opposite of that. Grinding lower all day, this heavy institutional selling all day. Our option flow was primarily bearish all day, and then right into the close here a little bit early. Usually it starts like last half hour. It's actually started last 40 minutes. We catch this bid then, and that's probably some profit takers, honestly, on short sellers that were grinding this down all day. That bid causes the market to break this pivot high, which sets off even more stops, which works the market even higher, which brings you back to this next pivot area, right as MOCs are flipping, right? MOCs then flip to the long side, which we'll talk about in a second here. That causes these pivots to break, which creates even more buying price action. And next thing you know, you go from a price of 448.80 to a price of 434 and change in like a half hour. That's a sick rally. This rally in the last half hour was like more than a typical entire day of price action almost any day of the entire summer. And it happened in basically 30 minutes into the close. And it's caused by a combination of those selling algorithms booking profit plus a feedback cycle plus the MOCs. So that's what happened there, and this honestly stinks, man. I'm disappointed with this. What a bunch of us here on the team, we all really wanted. At this point, the market was so weak. Stay weak, close at lows, gap down tomorrow. I kept comparing today's trading session, really Apple in particular, to exactly 1 year ago. Exactly 1 year ago. Let me zoom in on this chart. Do a few months back here. Exactly 1 year ago, let's get a little more perspective, was this low in Apple. September 21st, 2020. It's September 20th today, where we caught this top back here a year ago perfectly because the VIX was moving higher with the market in these last few days of August, beginning of September. So it's a real signal to get out of the way. Plus, the market went parabolic. It was super extended. I don't need to get into a full lesson on it. I really want to talk about this buy. The market on the 20th, on the 18th, it was a Friday into Monday. So the market on the 18th closed on lows, almost similar to what happened today. And then the market had a huge gap down the next day. So Apple was trading at 103.10 as the low of the day that day, with the ADMA at 112 and change. So Apple was even more extended a year ago to the downside than it was today, based on the way that I measure extension. And we came and we bought this day. Well, I bought 104 and I held that position until like a month ago. I basically was in this Apple position that I bought at 104 for almost a full year, because why not? That was the low. And it just kept going and worked out fantastically well. So that's what we wanted. We wanted this market to close at lows today, be super extended, and then if we could have just closed at lows and gap down, it would have been such a buy signal for tomorrow's open, like off tomorrow's opening low, like similar to today, opening low or panic selling low. It could have been like the buy signal of the year. We didn't get that, right? Instead, we got this rip-roaring rally into the close with the MOCs flipping, and what that left us with is this kind of annoying doji here, where we're not getting a gap. Like, oh my God, if I could have got a gap down to, I was half joking with Josh, but it was really only a half joke, 422. If we could have closed at 429 today, we easily could have gapped down to 422. That would have been a gap that would have been less than today's gap into this huge support level. It would have been like the buying opportunity of the year. But market's off. Most of the time, the market doesn't make it that easy. Every once in a while, like a year ago, it does. Most of the time, the market doesn't make it that easy. So it is what it is. We kind of deal with markets as they come. Today's price action is going to be really difficult for tomorrow. Like, especially if we gap up small tomorrow. We gap up to like 435, 436. That's going to be such a garbage gap. It's going to be such garbage for opportunity, because we're still going to be extended to the downside. It's not going to be a big enough of a gap up to short, but we're going to be $8 off the previous day's low. So there's nothing to be long, like there's no spot that you can be long versus. So we'll assess all that in the morning, but the way that we closed today, and unfortunately today's price action was really tricky, right? Because it was just this downside grind all day, and for me, for the most part, I was being hands off. I'm not going to come into the VTF just because we're doing an open house and try to be a hero and try to make up trades that don't exist, just for the sake of saying I'm doing stuff and making a ton of money or whatever, because that's not how I am. I tell everybody how it is. I almost had the worst day of my entire year today. I'll just throw that out there, because I'm not afraid to say it. I still had a pretty bad day because of my swings, right? I'm swinging long 14 positions. So even if I traded well intraday, there's a lot of damage from my swings. I almost had the worst day of my year today, and because of my swing positions with the rally, I was able to recapture a lot of P&L into that last 45 minutes. But I would rather have not made that money back, honestly. Whatever the number was that I made back in the last 45 minutes that made it probably not the worst day of my entire year. I'm actually not exactly sure. I would rather give that money up for the chance to lose even more money tomorrow by having a gap down, because I know that would breed so much opportunity that it would give me I feel really confident then it would just be this gift to be able to make back everything plus significantly more, and now I'm not getting that gift. So I'm not going to come here. I'm never going to be that guy and say, hey, come with me, and you're going to turn your $2,000 account into a $2 million account by the end of the week. I'm never going to be the guy who comes in and says, every trade is always a winner. I have a 100% success rate on my trades. That's a bogus lie. That person doesn't exist. I'm never going to be the guy who comes in and says he doesn't lose money. I lose money. I almost had the worst day of my year. I almost lost. I could have bought a car for the amount of money I was down at one point today. A decent car, not a piece of garbage used car. I'm not that person. I'm just going to kind of tell like it is. So I'm not going to come in and be a hero today and talk about how you could have made $1 bajillion today because of this price action. This price action was really difficult. Good opening trade, created the bear flag if you were able to come in and capture that, even though it was in extended territory to the downside of the market. Downside grind all day, crazy rally starting 40 minutes into the close. One thing that we do need to still talk about, though, is MOCs. Market on close orders, what they are, why they're important, because we're getting this information in the virtual trading floor, and a lot of people had questions on it. Maybe you're not used to seeing that information. Okay, so you've got these order types that you can put into the market. Market on open orders and market on close orders. We're specifically talking about market on close orders. And market on close orders create a market on close imbalance. And that's the number that we're looking at. So the early numbers for MOCs, because we're able to get those numbers fairly early. I think, Pat, what time did you first post that? Like 3 o'clock or something? Might even been before that. We were looking at 1.4 billion to sell. And when 350 came around, it was over $1 billion to buy. I think it was 1.1 billion to buy. That's a huge flip. I find generally that anything that is in excess of $1 billion to buy or sell is market moving. Early look usually starts around 2 p.m. for the NYSE, says Pat. So I tend to find anything that's in excess of $1 billion to be market moving, and especially when you get that big of a flip, 1.4 billion to sell to over $1 billion to buy. That's a huge number. That's going to have an impact on the market. So it's something that we're paying attention to. And what an MOC order is, I was trying to explain it on the radio. I'll re-explain it now, back when the market was open. So there are a lot of funds out there, a lot of hedge funds, a lot of mutual funds, pension funds, who need to own or sell the price of the close, right? So the price of the close in the SPY today was 434.04, right? $434.04. So there's a lot of funds out there who they need to have that price marked for their books, the actual closing price. So what they do is they put into the market a market on close buy or a market on close sell order. So maybe I'm a fund manager and maybe Pat is a fund manager. Let's just create a simple example. I am, for the Derrick fund, I need to buy 100,000 shares of Apple at the closing price. So I'm going to put in a buy order, 100,000 shares Apple, market on close. Give me the closing price. I don't care what the closing price is. I need that price. Maybe the Pat fund, for whatever reason, he needs to sell 50,000 shares of Apple at the close. So he's going to put in an MOC sell order, market on close sell order, to get the closing price for 50,000 shares. Well, I'm there to buy 100,000 shares. Pat is there to sell 100,000 shares. That creates an imbalance of positive 50,000 shares. So when we're looking at these MOC numbers that Pat's getting into the VTF for us really early on, and then they officially hit at 350, it's the total amount. So market-wide, we were looking at 1.4 billion to sell, and then that flipped to 1.1, I think, billion to buy at 350 when the number actually came out. And again, I find anything to be in excess of $1 billion to be market moving. So the market's expecting, and then what happens is the market begins to price it in. And there's algorithms that do this. I personally know people, there are people even here at T3 who have algorithms that are designed to take advantage of MOCs. So when they see that there's a buy imbalance, let's just say, of MOCs, there are more market on close buy orders than sell orders, their algorithm computes the math and says, okay, in order for these MOCs to be fulfilled, this buy imbalance, it's supply and demand, right? So a higher price creates more selling, and that can satisfy, and eventually by the close, that imbalance needs to be evened out to zero. So they even out the MOCs to zero on the closing print. That is why the biggest volume bars of the day are almost always the opening volume bar and the closing volume bar, because they have to settle the MOCs for the market. So the algorithms come in, all right, the algorithms think it's going to be 1.4 billion to sell. So they're driving the market down to make up for that. And then, oh my God, it's 1.1 billion to buy. Boom, flip. And that drives the market all the way up. So that's why we pay attention to that. You know, similar to like option flow, which is the next mini lesson that I need to talk about, because there's a lot of questions about that, because we get that into the VTF. Similar to option flow, I'm not necessarily executing on this stuff. It's all information. You know, so what I'm trying to do more than anything in order to be a successful trader is I'm trying to bring in and I'm trying to absorb all of the information and how it affects the probability of movement in the market. And then when I can combine probability of movement with execution, right, an actual trade setup that gives me a defined risk reward, that's how you make money. And again, the execution, the being a good executor takes skill. Risk reward math is very simple, right? It's just like, okay, I'm risking 10 cents to make 50 cents. It's all this other exogenous information that you need to be able to digest into your brain in real time that affects the probability. That's the hard part, right? And that's all the stuff that we're trying to digest. So speaking of probability, the next thing I want to bring up, and I see there's a ton of questions that are coming in. I'm just going to go to questions at the end. So speaking of probability, the next thing I want to bring up, because there were questions about this as well, and some of the better potential trades that were out there, even though we're not involved in them, were based on this as well, is option flow. So again, thank you to Patrick. We do an excellent job of getting the large, probably institutional option order flow into the virtual trading floor in real time. Why do we care about this? Because one, it's market moving because their orders are big enough. And two, if you understand how market makers work, and that's another thing you should read Pat's note from the other day, you'll understand even more on how it actually moves markets when they're big. But really at the end of the day, what the large institutional option flow is doing is it's giving us an insight into what the big money is actually doing in real time. One of the cool things about Kathy Wood and her ARC fund, I don't agree with a lot of the stuff she does. I don't agree with a lot of her positions. Some of them I do, some of them I don't. The really cool thing about her, though, is that every single day we can see what she did yesterday. We can actually analyze what she just did yesterday. But when you're looking at hedge funds and you're looking at like 13Fs, that's from what they did a quarter ago. You don't even know if these guys are still in the positions anymore by the time it gets announced, and you really can't execute off of it. But large institutional option flow is a signal to us on what the institutions are actually doing in real time. So if I'm looking to go long a stock and we're seeing all this bullish option flow come in, that just means that my trade is going to have a higher probability of success than it would be otherwise. I don't just close my eyes and blindly buy stuff, and this probably is not going to be a winning strategy. Let me just close my eyes and blindly buy stuff because we see a big option order come in, because you still don't know all the motivation. It could be a hedge, it could be a new position, whatever. But that's stuff we're paying attention to. So just for example, today, one of the best, so we saw, first of all, we saw a ton of bearish option flow coming in, starting very early on. We saw Bullflow coming into VIX products. We saw bear flow coming into Apple, bear flow coming into SPYs, bear flow coming into Qs, I think bear flow coming into the IWM. Uber, right away at like 9:35, and maybe Pat, you can repost if you got it. Pat starts posting bullish option flow in Uber. It's not a coincidence that this stock went green after 15 minutes and was one of the strongest stocks of the day. Where else? LCID. Lucid, one of the best names of the day here, still trading up even further after hours. They filled this gap, it was so strong, green all day. Yeah, a couple little dips here, but you know, making new high. This thing was just so strong today. Bullflow, hitting it all day. And then where did the bearish flow for the market switch to bullflow for the market? Where did we start seeing that happen? Basically at market lows or just thereafter, right? All the bullflow and VXX, UVXY that we were seeing, bear flow and SPYs and Qs, that flipped real quick here. Where all of a sudden we saw bear flow coming into the VIX, bullflow coming into the indices. It's not a coincidence. So it's stuff that we pay attention to, again, as a layer of probability. Okay. So I'm sure there's plenty of clarifying questions. That is basically everything I wanted to talk about. So we got lots of great mini lessons for you guys here today, just based on this market price action being exciting, even though it was not the easiest day in the world. It was an exciting day. Again, how we handle gaps, how we understand risk reward based on the gap, the balance between dip buyers and panic sellers coming in. That's one thing. Right? We understand the into the close trending algorithms and how they can flip for profit taking, what they can do that to the price action. We have a better understanding of MOCs. We have a better understanding of option flow and the importance of option flow. All of that we're able to derive from one really crazy trading session. So happy you guys are able to join the pro desk when we had such an insane day today. Again, even if it wasn't the easiest day in the world and I was smoked at one point today, it's cool because we're able to derive a ton of lessons from it. And that's what we do here. You know, we want to absorb these lessons and absorb this information to help us be better traders in the future for when these similar situations occur. I've seen days like today so many times now over the course of my career that it's every day and every situation is always a little bit unique. But there's these bigger picture repetitions that happen all the time that can enable us to position ourselves big picture to be able to be consistently profitable. So I'm happy to answer any questions that you guys have here. I'm going to scroll up in the VTF like I always do to see where the questions begin. So I'm at like 420 here or so. Seeing Amber post some links for the team. I appreciate that. First thing I'm seeing here is from Edge Guy. Look at the roughly triple volume accomplished on the finale of the run-up at the close. Yeah, the market action here was insane. And again, I still have the SPYs up, but you can look at the Qs also. The MOC flip was so big. Look at the volume here on the closing bar. And also, let's look at daily candle volume real quick. I got the VIX up, VXX. Biggest volume on the VXX of the entire year. Right? Every other time the VXX got this big, it was a top for VXX and a bottom for the market. I have no promise to you guys that this is a top for the VXX and a bottom for the market again. But definitely really impressive volume there. You know, the SPY is also huge volume, similar to other bottoms, not quite as big as the March bottom for the Qs. But that combined with the tail today, it could really lead to something, you know, Qs as well. Yeah, so for sure, thanks for pointing that out there, Edge Guy. Good to have you here on the team today. Jerry with the next question. By the way, for people who are new, we do a team Q&A at the end of every afternoon meeting. So this is your opportunity, guys, to ask any questions about anything. And I try to stay here. I do have some finite time, but I try to stay here for as long as possible to go through everybody's questions so we can all improve. And any questions at any level of experience are always welcome. From Jerry here, can you share your thoughts on how the price action of a big gap down like today compared to the bear market kind of gap down like the COVID sell-off. Sure. So the COVID sell-off was the ultimate example of an extended market becoming more extended. Let's start with that. Here's the whole thing. You thought the market was extended to the downside when I got the Qs up still here. When the Qs were at 415 and the ADMA was when the Qs were at 214 and the ADMA was at 227. Well, next thing you know, 2 trading sessions later, the Qs are at 198 and the Q ADMA is at 217, right? And we're extended by $20 to the downside in a $200 ETF on a percentage basis, right? Big. I think when you get 10% extension from the ADMA on an indice, it's big. And even then, look at this. We still had this huge relief rally here. The ranges were so big that it only took 2.5 days. But we had this huge relief rally where it caught this move from 198 to 219. So the truth is that the gap rules and the extension rules still applied even in this sell-off. But this sell-off, this was the most insane price action I've ever seen in my entire career. It's the only time I've ever seen the indices get circuit broken and have to get halted. And on certain days it was like right off the open. It was like 932 and they were holding the indices. It was insane. We need to take everything case by case, right? We need to assess the big picture trend. At a certain point here, you had a big picture downtrend. We don't have a big picture downtrend in the market right now, though you could definitely make the argument that the big picture uptrend in the market is broken. We don't have a big picture downtrend. You also want to, and this gets a little bit subjective, and you gotta be a little bit careful with it, but I describe my approach to trading as 85% technical, 15% fundamental. The fundamentals I look at are more on the qualitative side, basically the story, as opposed to our great friend Stefan here in the VTF, who is our more real fundamental guy. We can get information from him on assessing actual fundamentals on stocks. I'm not sitting here analyzing balance sheets and doing cash flow analysis or discounting cash flow or anything like that. I'm assessing the story. People who were on the VTF back in January, February 2020 probably remember that I was getting smoked to the short side because I was so adamant in way too early about the story of the market creating one of the biggest bear markets we've ever seen because of COVID. I was telling people in early January, mainly because of my connections to friends who are connected in China, and I knew what was going on over there. I don't want to get too deep into the weeds here, but the story was so different. I was telling people in the beginning of January they need to go out and buy canned food and masks. I was able to walk to my corner hardware store in the beginning of January, walk in and buy the only package of 50 N95 masks that they had, and then I ended up having to give half of them away because when COVID really hit America, people who were family members and friends who had family members who work in the healthcare industry couldn't get N95 masks, and here I was sitting on 50 or 60 of them, and I ended up giving them most away to healthcare workers because they couldn't get any. That's how early I was on this, and I was stupid because the technicals didn't confirm the thesis, and I ended up getting smoked short because of COVID. But I said from the beginning that the story here was different, that it was creating a global economy shutdown. I was short a Chinese travel company when you could not travel in China in January, and the stock wouldn't go down, and I was pulling my hair out. TCOM. And it wouldn't go down. I'm like, my friends in China are telling me that they're being locked in their apartments and that there are no flights and that you cannot travel, and the Chinese travel company is going up every day. Like, yeah, the efficient market hypothesis, sure. I think that story was very different right there, but we also got to know that the market was in a downtrend and feedback cycles. Selling leads to selling, and if we see extreme selling again in the market, and I don't consider what we saw today to be extreme, not compared to this, it becomes a feedback cycle because the margin calls come in. And another thing we talked about in the VTF today is a big thing right now, and people are doing it in crypto too, which blows my mind, but a big thing right now is you got people taking out loans on their portfolios because you can do it for 1% interest. So why sell your stocks and have to pay capital gains taxes if you're a rich individual when you could just take a loan for 1% on your equity portfolio that has not had too much volatility, albeit it just did over a year ago, and you could just have the money without having to realize the capital gains taxes. It's actually somewhat brilliant as long as you don't get over leveraged, because if you get over leveraged and the market goes down, then they're going to sell your positions for you, right? So markets work in feedback cycles. Buying leads to more buying, selling leads to more selling. We're not at that point now for this market, not yet at least. I don't see a story in the market that is equivalent to coronavirus. Are there bad things out there that are part of the story? Sure. China real estate thing, obviously not good. Tapering, arguably not good. Increase in interest rates, arguably not good. You know, the longer I've been in this business, the more I've seen that the Fed dictates the market more than anything. But they still haven't really pulled their foot off the gas, not yet. And if China creates contagion to here, then guess what? They're especially not going to, which is going to help the market hold up even more. I don't see that story yet. So if we closed on lows today, then maybe we could be getting it. But even like I said, when I was just reviewing the price action from 2020 coronavirus, look at that rally that we had in the Qs from 198 back to 218. It's a $20 rally over the course of 2.5 days, and it was based off of extension and gap rules. So it still applied even in that. So we'll still pay attention to it on a day-to-day basis. I just don't think we're looking at that kind of market yet because of the story. So that's my answer to you on your question there, Jerry. The high of the flag, Gabriel says on the SPYs, was also the VWAP. I don't have the VWAP on my charts, but I believe you. Jack here, do you ever take pre-market and after-hours data into account? The ADMA on the chart with extended hours is a little bit different. Yeah, I do. I do, and I pay attention to it more pre-market than otherwise, but I'll tell you why. 9:30 comes around, and I'll usually leave like one chart of the SPYs that I have with the pre-market price action, but I primarily go to 9:30 to 4, and I'll tell you why. It's because of volume. So, you know, here at T3, we have retail accounts, we have professional accounts. They have trading access from 4 a.m. to 8 p.m. Eastern Time. But look at the volume at 4 a.m. Look at the volume up until 9:30. It is dwarfed by the opening price action. So implementing moving averages on these time frames based on the pre-market price action when there's no volume, I don't think it's appropriate because of the lack of volume. And then if you look at most stocks, if you look at like a Coursera that I'm in, look at this thing traded like 100 shares pre-market. Like if you're looking at charts that have pre-market price action in most stocks, yeah, not Apple. Apple trades pre-market, not SPYs, not Qs. But if you're looking at most stocks pre-market, there's zero trading that's occurring. And if you keep this chart up intraday, this pre-market, post-market price action is distorting the chart so badly that it makes it borderline unreadable. So for me, I look at pre-market. My charts are all pre-market. When it's pre-market, I keep track of these levels, right? I was saying when the market opened, I was saying, all right, you know, SPYs here in the day here are trying to hold this 434, but we've got to remember that 433.50-ish was the real pre-market low that we need to remember. They tried to hold that here. So I remember the key pre-market levels when there is pre-market volume. I remember the pre-market opening high and low, but for the most part, it distorts the charts. It's a much better chart to read it like this. So that is the answer to your question there, Jack. Yep, Joanne, we got your question already taken care of. Jacoby. Why was today not that day? We closed at lows on Friday, gap down. We weren't extended enough. And in some ways, even though we closed at lows on Fridays, we're a little bit distorted here on the SPY chart because of the ex-dividend. But we really just kind of closed still in it, more or less in the consolidation. We didn't have a real big breakdown in the SPYs on Friday, and the gap down wasn't big enough either. You know, we broke the opening low, really. It could have been it. You know, that's why, Jacoby, that's why we were still looking for these opening lows. Because it could have been it. It could have just been another, you know, gap down similar to some of these other days here that we've seen. And next thing you know, 2 days later, we're making new highs. So that's why the opening game plan was longs. If the opening game plan was longs, and then we get a higher high and a higher low, and we break the ADMA, and then we're having a 15-minute price correction, and we get up to 438, and then we go sideways in the middle of the day, and then we rally back to 440 into the close. It's business as usual. You bought the dip because you bought versus the opening low. And that was it. So that's why the game plan is what it is. That's what we're looking for. But we also understand that there's going to be true institutional selling if that opening low breaks and you get out of the way. So that's that. Joe Trader Florida, would you say, Derrick, there was significant technical damage, done today, and look for a retest potentially taking out today's low? That I don't know about. I do think that there was big technical damage done today. It kind of already started last week. I'm not a big believer in the connect the dot game, where you just draw lines and you connect the dots, and you call it trend line support. I'm more of a believer in my definitions. The definition of an uptrend is a pattern of higher highs and higher lows. The definition of a downtrend is a pattern of lower highs and lower lows. So we did break that trend line support, so I do recognize that can be a self-fulfilling prophecy. But more importantly, we are no longer in an uptrend in the market. It's a powerful statement because we've been in one all year. We are no longer in an uptrend in the market. Depending on your time frame, we're not in a downtrend either. Right? Yeah, you could argue a little bit here in September that maybe this was a low and a higher low and this is a lower low. You're kind of pushing it a little bit. Maybe really small time frame on the daily chart, you can make an argument that we're in a downtrend. But I would argue that we're not really in a true downtrend until we see a rally that's met by a lower high and then a lower low. Meaning we need a rally, a lower high, and we need today's low to break before we're in a downtrend. So, was there significant technical damage done to the market today? Yes, there was. Are we in a downtrend where I can expect lower prices and I can expect that today's low is going to break in the future? No, we're not. We're in between. We're somewhere in between. We're kind of in no man's land. So our extension rules are going to be important. We're still really extended, right? SPYs are at 433, 434. ADMA is still, we're extended to the downside by $10 here. Is today, with this tail, going to lead to higher price action where maybe we see a lower low and we should be looking at shorts into 440, something like that. Sorry, a lower high at like 440, somewhere like that, that can lead to lower price action and downside continuation. That's what we want to be looking for. That's what we want to keep an eye out for, to then see if this could become bigger. My opinion is that the Chinese real estate thing is not as bad as coronavirus. My opinion could be wrong. The price action will let us know, right? And the price action will let us know if we get a lower high and a lower low, like we got with coronavirus. And we'll take it from there. Right now, we're pretty extended to the downside. And there is technical damage that's been done. Next here from Rich. Is the money you were down today? Yeah, primarily, Rich. I wish I could say 100%. So Rich, who's been part of the team for a long time. Rich, how long have you been part of the team? I'm not even going to see your response because it's going to be so far down the chat. But you've been part of the team for a long time. Originally starting with T3, I know, a long time ago. So I know, and I always appreciate your questions because you ask questions that you know the answer to, and you do it so that the rest of the team can learn, and I love that. I do that in martial arts a lot. When I'm at a martial arts conference and I see an instructor try to make a point about something, and I know he didn't fully get across the point properly, but I understand what he meant. I'll raise my hand and I'll ask a clarifying question, even though I know what the answer is. I do it for the benefit of everybody else, and I know you do that, Rich, and I appreciate it. Yeah, so for me, for open swing positions, I'm a big believer in risking money that I've already made in order to make more. It's called a win-win situation. So even though I was smoked today, it was primarily me giving back money that I've already made. And I love that. I'll do that all day. I love risking money that I've already made in order to potentially make more. It enables me to risk larger amounts to make larger amounts than I would otherwise. The amount that I was down at one point today, I would never come in and risk in a day. But to give back money that I've already made for the potential to be able to make more, I'm about that life. That's the money I love to risk. Yes, Jacoby. The MOCs is cumulative. Next here, Robbie Stonks. Neo. Robbie Stonks, are you in the Pro Desk open house this week? Because you can be part of the team for the week for free. So if you're not, reach out to info@t3live.com. Robbie Stonks from YouTube asking about Neo. Yeah, Neo is not good being below $36. I love this company. I'm a big bull on this company, but technically opening below 36, this was a breakaway gap to the downside. It closed really weak today. Neo is not looking good technically. Your next area of support is like this 32.50 area, and we're still a ways away from that. A bit extended to the downside, but I'm not ready to come in and buy Neo. This does not look good technically, even if I do like the company. Joanne with a follow-up on MOCs. Today's upsurge, does this normally mean carry through, but for tomorrow, yeah. Just a little continuation, then another drop. I know you're looking for, I know you keep asking the question because I know you want me to say that the market's going to give us another drop. I can't say it. I don't know. I have no reason to believe that the market tomorrow is going to drop back down and is going to break today's low or anything like that. If anything, there's a lot of signals that are going to tell us the opposite. That we should probably gap up tomorrow. We have a high volume tail here. We have a VIX that you could make an argument capitulated to the upside. If anything, right now the ball's in the bull's court, and it's for the bears to steal it back into a rally. I would be surprised if we broke today's low tomorrow, based on the rally that we had in the close. We'll see. You know, there's a lot of volatility. Let's assess how we gap tomorrow. We'll see. But based on the volume, based on the tail, based on the VIX, based on how we closed, and based on the extension, keep in mind, even with that rally, we went from $15 extended to the SPYs to $10 extended to the SPYs. We're still decently extended to the SPYs. I would be surprised, unless a real additional event occurs, like new really bad news coming out of China or something like that, I would be surprised if we break today's low tomorrow. I'd be really surprised. There's no signal for it here in the technicals at all. Where do we see the bear or bull option flow? Pat posted into the VTF all day. So one of the benefits, like I said earlier, even if my assessment, I like to think I'm a decent trader. I've been doing this for a long time. I've been able to make a living. But even if you don't care about anything I have to say, it's worth being a subscriber to the VTF just for the information that we get on news and option flow. Can you put an alert or scan for bear or option flow in TOS? I have no idea. I don't trade in Thinkorswim. I trade professionally through T3 Trading Group. That's not a signal that any of our accounts provide. But again, we get into the VTF. So if you can combine the ProDesk VTF with a professional trading account, I think that's where you want to be. So if you're interested in a professional trading account, reach out to info@t3trading.com. Thank you for the compliment, PG. He said I did an excellent job today. I assume you're talking to me. I appreciate the compliment. Thanks, Rich. Appreciate it. Camille likes my style. Appreciate the compliment. You're a beginner trader. That's great. How can I start learning from you? Starting with the basics of trading. The best way to start is with access to my training program. My training program class. I think what you want to do is you want to combine the training program classes with the Pro Desk virtual trading floor, because your base of knowledge is going to come from the training program classes, and then we build upon that base of knowledge here in the VTF, particularly in the afternoon meeting each day. So again, here we're answering questions. We do all this review, so that's what I would recommend. Reach out to info@t3live.com. Next from Thomas, I missed most of the recap. You can catch it on YouTube. So because a couple of people, I wasn't planning on live streaming the afternoon meetings on YouTube this week because you guys all have access to it through ProDesk, but enough people said that they were going to miss the afternoon meeting or miss some of it, and they wanted access to it, so I am streaming it. So you guys all should be subscribing to T3 in YouTube, T3 Live in YouTube, Derrick the Trader in YouTube. You'll be able to see the afternoon meeting as a recording in YouTube on the T3 Live YouTube as soon as the meeting is over. So check that out. We're just trying that as an experiment right now. Visiting says it doesn't matter the story, only the price action. I'm not going to disagree with you on that. That is the exact same statement that I used to say for years in the beginning of my trading career, at least the first half of my trading career. I don't fully agree with it anymore. My best trades are when I'm able to combine the story and the technicals. I never buy something purely based on the story, except for maybe BOX. I almost never buy anything purely based on the story. I was listening to a hedge fund manager, and I really can't remember who, on the Barry Ritholtz podcast, which I also can't remember what it's called right now. I'm having a mental blank. It's one of the podcasts I listen to. I could look it up for you guys if you want. And he had the guy on one time, and he was like, I'm a big believer in fundamentals, but it's the technicals that tell you the when, where, how, and why. Or no, the fundamentals tells you the why. The technicals tell you the where, when, and how. So you can have this belief, like I was saying, that the market should go down because of coronavirus, but until the technical signal was there, you were better off being long and short. And that's what I've been saying to the naysayers about this bull market for months. There's been so many people who've been wanting to be short this market. And I know institutional guys, I know fund managers who have been trying to be short the SPYs and Qs for months as a hedge, and they're getting smoked because of it. There's no technical signal to do it. Until maybe now. Until maybe last couple of weeks. Pat posted the bearish VIX divergence, right, that we saw happen earlier this month. It's the exact same thing that we saw a year ago. So I actually do believe in the stories as well, and I do believe in a degree of fundamentals for sure. And I care if a company has a buyback. I care a little bit about if they have cash flow. I care a little bit about what that story does. Why has NVIDIA and AMD been so much better than Intel? Intel's got better fundamentals, but AMD and NVIDIA have the story and they have the technicals, right? The combination. Anyway, can I talk about stop losses? Is the question from Robbie. Sure. So a couple things on stop losses. You need to have one for every trade. So let's go break it down to real fundamentals here. In trading, there are three definitions that are extremely important to me: the definition of trade, the definition of trend, the definition of momentum. My entire trading philosophy is based off of these three definitions. Any and everything I do in trading can be broken down to these three simple definitions: trade, trend, momentum. The definition of a trade. The definition of a trade is something with a technical reason and a technical out. Another word for out is stop loss. Definition of a trade is something with a technical reason and a technical out or a technical stop loss. basically what that means is you do not have a trade if you just are buying because you have a reason to buy. You have half of a trade. If you just buy because you think a stock is going up and you don't have a stop loss, it's not a trade. You're either gambling or investing because you only have half a trade, and half of a trade is not a trade. It's not a trade at all. The definition of a trade is something like a technical reason, a technical out, or a technical stop loss. If you are entering a position, you need to know before you enter the position where your stop loss is going to be, where you're going to take a loss if you're wrong. And it also should be based on the technicals. The technicals tell you the entry and the exit. You don't tell the market tells you. That's why I take issue with people who use their entry price as their stop loss because the market doesn't know or care what your entry price was. You should be choosing a stop loss that the market tells you is appropriate, not the one that you want. It's not, and here's another thing, new traders all the time I speak to who say, one of my favorite questions to ask is, well, how do you manage risk? And they go, well, when I buy, I set a 1% stop loss, or a 2% stop loss, or a 40-cent stop loss, or a $1 stop loss, or whatever. They give me some random number, and I applaud them for trying to have rules, but the rule is based on the wrong thing. That's what you want. You want to use a 1% stop loss. The market doesn't care about your 1% stop loss. The market cares about the market. So, again, we get into this in my training program classes. Check them out. But we like one example of an appropriate stop loss is a pivot point. A pivot point is the spot where buyers took control from sellers or sellers took control from buyers. It makes it technically significant. It's a good point for a potential stop loss or a trailing stop loss. So that's how you want to be thinking about stops. So you've got your initial stop, and then we also have trailing stops. And again, my entire training program is getting into this for hours. So definitely recommend that you check it out, Robbie. Fish doesn't understand. The question is, I don't understand how things can gap down on such low volume. I'm not sure I truly understand what actually drives price action higher and lower. Futures market. Anything can happen. Diego has been trading for over 20 years. Diego's a great part of our team. I'm actually reading a book right now that two of my traders in. The copy's at home. I wish I could show it. Diary of a Black Man on Wall Street is what it's called. And Diego is mentioned in it. And Greg, if Greg's still here, is mentioned in it. Really proud to have two guys on the team who I can actually read about you in a book. That is so cool. But yeah, the gaps are often based on Asian European markets and really our futures market. The futures market drives, because the futures market's trading 24 hours, right? So if the S&P futures market's down, then the S&P market is going to open up down. And that's moving, again, based on news and overseas and all that stuff. Next here from PG. How do you like stocks break out the opening range within the first hour of the day? What do you look for to keep the moving going? So I don't really do opening range breakout trades. I know a lot of people do. Since the Jade Room says Rich. Sorry, I just saw that. I could not laugh. So Pat, if Pat's here, you can explain it, or you can explain it on the radio maybe tomorrow. Pat does like an opening drive, opening range trade, particularly in stocks that have news like earnings reports, based off usually I think an opening 5-minute candle. He might even use an opening 2 at some point. I don't really ever look at charts less than 5 minutes. Again, guys, I'm a big believer that my way is not the way, right? It's like Bruce Lee said, be like water, right? If water goes into the cup, it becomes the cup, right? Water can flow, water can crash. The way that I trade is not the way to trade. It is a way to trade. And you need to find the way to trade that is appropriate to you. And the best way to learn the way that you should trade is by learning from as many resources as possible. That's why T3 is so cool. You can learn from Scott Redler. You can learn from Sami Abu-Saad. You can learn from all those awesome people. You can learn from Pat. You can learn from the great team that we have here in the ProDesk VTF. You should learn from other resources also. and then make it your own. That's what I did. I learned from so many people over the course of the years, and I'm still learning. Now I learned from all of you guys now. You know, some of you guys have taught me so much over the course, even the last couple of years. I've been doing this for over a decade. I'm still learning all the time. So, be like water, right? Anyway, I don't really take an opening range trade necessarily. I pay attention to it, and I pay attention into it in conjunction with a lot of other information. Extension, volume, all this stuff that we were talking about. But maybe we can get Pat to comment on that more at some point. Silver here. Just want to thank you for the analysis. It's helpful and appreciated. No problem. That's what we're here for. Happy to help out. Diego also giving a shout out to the training program. I appreciate that. Some chatter here that I'm scrolling through. Do you use any algos or coding, or is it all off of intuition and experience? I don't trade algorithmically. I do have a strategy that I trade manually, which is a quantitative strategy, but I do it by hand. It easily could be coded, but I sit here and in front of the computer all day, every day anyway, so I just kind of do it by hand. But here at T3, we have very robust, T3 Trading Group, we have very robust algorithmic capabilities. Sean Hendelman, who's the CEO of T3, was one of the first in the algorithmic space in the early 2000s. I think to this day, his robots do like 2% of the New York Stock Exchange's volume on a day-to-day basis. Needless to say, he's been extremely successful. So we do have that here, but I'm not personally. I can't write a lick of code. So I press buttons. From Sarah, I joined T3 via Jeff Cooper's Hit and Run Trading. I see a lot of options here, but don't know which options I should focus on. You mean with T3 in general? Well, I'm sure that the folks over at T3 Live or your trading counselor will have an opinion on it. Generally, I would say check out multiple people, multiple spaces like you're doing, and see what works best for you. And like I was just kind of explaining, you want to try to learn from multiple resources. I'm obviously biased towards ProDesk here. This is where a lot of our professional traders here at T3 Trading Group are located. But you really want to, Jeff Cooper is a great guy. He's been in the industry for a really long time, and there's a lot of other great, moderators around, and you should, see what works for you. And if you decide that ProDesk is best, I won't be surprised. But like I said, I'm biased. Everyone here is great. At a certain point, MOCs were 1.4 billion on the sell side, and then it flipped to 1.1 on the buy side. Yeah, I was wondering when those orders are executed at the close. At the close, yeah. So again, like I was saying, so just to add on to what I was saying earlier about imbalances. So we're seeing these imbalances start to leak out around 2 p.m. But you can still put in an MOC order. So if the MOCs market-wide were 1.4 billion to sell, and then I put in 1 million MOC to buy, let's just say, well, then guess what? Now it's 1.3. And the next guy puts in 1 million, now it's 1.2. And next guy puts in 1 million, it's 1.1. So that's to buy, right? It's satisfying some of that imbalance. So it's a dynamic thing, and that's what happened today. We don't see flips this big this often, but we don't see price action this big this often, right? It was a crazy day today, and no problem. I hope I answered that question properly for you. Trademark. I've heard you remark that you don't use trailing stops. That's not true. I do use trailing stops. What I don't use is, I've had people ask me, so I've had people who joined T3 who have been retail traders in the past using like Thinkorswim or whatever, and they ask me in our software about how they can use a automatic trailing stop. One, our software doesn't have it, and if it did, I would never use it. Because again, if you're using an automated trailing stop, you're automating it based on a percentage or a cent amount. And I just explained on why I disagree with that. I disagree with just auto trailing based on 1% of price action. I disagree with trailing on every bar. I disagree with trailing by a certain cents amount. We want to trail based on the price action itself. The price action tells me. I have a whole class on this. It goes for about an hour and a half. It's my game planning class, and it gets into my 3 rules of trailing. I also did. Is it in here yet? I don't think it's in here yet. But again, follow. This is why you can. This is why you should subscribe to it. Let's see if we got any more subscribers. Let's see if you guys are listening to me or if I'm just blowing air here. Subscribe to Derrick the Trader on YouTube because I'm posting these mini lessons on here. Oh, look at that. We got an extra 10 of you guys came in. But I'm posting these mini lessons in here. I filmed one recently that's a short version of my rules for trailing stops that they'll probably put on here eventually. If you want the big one, you gotta get access to my actual training program. But give Derrick the Trader a subscribe. Lawns here. You mentioned training program. Yeah, the Pro Trader Bootcamp home study course. Yeah, that is that's the long-winded name for my training program. All right, guys, it's 5:30, and I got to the end here. I assume that means we covered all questions. Yeah, again, difficult trading day, but I'm glad we got it because there was so much to learn from today's price action. So I'm hoping everybody's learning, first and foremost. Secondly, I hope that we get some opportunity where we can make ourselves some good money. Guys, subscribe to Derrick the Trader on YouTube. Subscribe to ProDesk VTF on Twitter, at ProDesk VTF. Reach out to your trading counselor or info at t3live.com to learn about how you can become a member of the ProDesk virtual trading floor or any of the other great virtual trading floors that we have here. We've got solid teams with different approaches, great place to learn from a lot of different people. Or if you're interested in becoming a professional trader with T3 Trading Group, we do also have retail accounts at T3 Trading Group, but they're really more for kind of professional traders who want to stay in retail accounts. If that interests you, reach out to info@t3trading.com. info@t3trading.com on how you can become a professional trader. All right, gang, it's 5:30. I'm hungry. It's been a long day. I've already been at the office for almost 12 hours, and I got a lot more work to do. I'll see everybody tomorrow morning where we will assess the news, the gap. We'll come up with a game plan. We'll do all that great stuff. Love having you all today. See everybody tomorrow.